If you look at the Weimar hyperinflation from month to month, it gets wild in 1922 and 1923, and that wildness is going to be replicated here. So you've got to have the emotional stability to stay through this game because it is about to enter its final innings. Well, hello there, my friends. Rafi here from the Endgame Investor with this week's silver report for Arcadia Economics, and it is getting exciting out there in monetary land, in the stock market, in every market in the world. You can feel the teetering, you can feel the swaying. Which way is it going to fall? We all know which way it's going to fall. Markets are going crazy. Bitcoin has crashed. The NASDAQ and the S&P are falling hard, and the innovation stocks are all dying. And yeah, the spot silver price is low, but the premiums are very high, which means that the paper price is wrong, because if you actually want physical silver, you got to pay a lot more. So today, we're going to go into the plumbing of the financial markets, going into the secure overnight financing rate, aka the repo rate. Something is happening, and it looks to be the opposite of what happened during the reapocalypse, when rates skipped up to 10% overnight. The Fed has now raised its overnight financing rate to 1.5% with a 75 basis point hike, which has met and exceeded the downtrend line in the effective federal funds rate since 1985. And that means we are due for the final financial crisis anytime now. I believe it will be this year. Now, the ultimate question is, will the final financial crisis bring the paper silver price down to record lows again, like it did in March 2020? It is entirely possible. I am not a shill for saying that silver will always go up, because it is possible that the final financial crisis will cause huge leverage positions in the paper silver market to unravel, very temporarily causing a crash, but not for physical prices. One thing that must be understood about hyperinflation: it is not a straight line up in prices. It is not a straight line down in money. It is a wild ride of ups and downs. If you look at the Weimar hyperinflation from month to month, it gets wild in 1922 and 1923, and that wildness is going to be replicated here. So you've got to have the emotional stability to stay through this game because it is about to enter its final innings. Anyway, it has a fantastic balance sheet in that its net debt to market cap ratio is about 5%. And that's with its stock price trading at the lower bound of an 11-year trading range. So you have very low stock price, but even despite that, its debt to equity is only 5%. So yes, Fortuna can survive pretty much any silver crash, because any silver crash will be temporary and it will not last any longer than a few weeks or months at most. So if you're looking for miners that can survive and thrive in an environment of a financial crisis, Fortuna is certainly one of them. I think I want to show you something going on in the open interest for silver. It has been going on since around this time period, just before the bottom. The bottom in silver is over here at about 2050 or so, right? And we're still higher than that bottom, but since then, open interest has jumped from about, looks like 135,000 contracts to what looks like now 155,000 contracts. 20,000 contracts in the silver market is a lot because open interest is relatively thin in the COMEX here. But what this means, if open interest is higher with the price lower, right? We see a big spike here in this bar, looks about 10,000 contracts. If there is a higher open interest, that means that the bullion banks who sell these contracts, they are forced to go short, because short has to equal long. If there are 155,000 contracts long, there are 155,000 shorts, and the bullion banks have to supply those contracts, which means this could be a setup for the beginning of a short squeeze. And we always talk about short squeezes in silver. Eventually, there will be one like there was in 1980 when open interest collapsed and the price went to 50. When that happens again and the paper markets collapse, there will be a short squeeze in the open interest, and it will fall sharply as banks are forced to close their positions without covering in physical silver that they don't have. Now, here's what I wanted to get to in the repo market. On the left, we have the repo rates for June 1st to June 14th, right? This is all within a range. The lower bound target for the Federal Reserve has been up to yesterday when they hiked 75 basis points. It was itself 75 basis points. It is now 150 basis points, or 1.5%. You see here that since June 13th, and that's when things really started to get out of whack in the bond market. On the short end, on the overnight SOFR repo rate, it went below the lower bound of 75. See, it's been going lower since June 1st, 80, 79, 78, 77, 76, 75, finally 73 on June 13th, and then June 14th, 69 basis points. Why is this happening? It is the exact opposite of what happened during the reapocalypse of September 2019, which is when overnight rates in the effective federal funds rate went to about 10%. But here the SOFR rose from, here you see 2.12 on September 9th, then 2.14, 2.5, 2.2, 2.2, 2.43, and then this is the reapocalypse of 5.25. That was the peak of the crisis. Why was that? Because there were not enough reserves, cash reserves in the banking system in order to provide repos at acceptable rates. So the Fed had to print more, and that's when they started expanding their balance sheet again. But now what you have is the opposite. It looks like a reverse reapocalypse could be brewing now. And why is that? Because there's 2.2 trillion extra dollars in reverse repos that are in the banking system that have nowhere to go, and they are overcrowding the reverse repo facility. And it looks like a lot of this cash is instead going into repos, which is pushing the rate down instead of up. So who knows what a reverse reapocalypse in all its glory might look like? I have no idea, because I'm not, a monetary quantum theorist, and nobody's ever dealt with any of this stuff before. But conceivably, if the rate here could go up to 10% or 5.25% in this specific instance, the rate of the repo rate could theoretically go below zero or something, or maybe something close to it. And who knows what kind of weird earthquakes that would cause in the monetary system. Nobody knows what's going on now. It's so crazy. And here we have also a rumbling, this sort of swaying that we're seeing in all markets. Crazy swaying one direction, another direction. We're seeing it in the Japanese government bond market. And this market is angry because the Japanese bank, but the Bank of Japan, has pinned interest rates at 25 basis points while Japanese inflation is starting to move higher and the yen is in collapse. And so you have a lot of hedge funds and all these market players like George Soros did to the Bank of England